SCHD just made a bold move with its share split, and it's got everyone talking. But what does this really mean for you as an investor? More importantly, is now the perfect time to add this dividend powerhouse to your portfolio? In today's video, we're diving deep into SCHD, why Schwab decided to split its shares, what this means for your investments, and how it compares to other top dividend ETFs. Whether you're looking for steady income, long-term growth, or just curious about what's next for SCHD, you're in the right place. But before we get started, make sure to hit that like button, subscribe for more insights like this, and drop a comment below with your thoughts on SCHD. What is a stock split? A stock split might sound complicated, but it's actually quite simple. Imagine you own a slice of a pizza, and that pizza gets cut into more pieces. The size of the pizza doesn't change, but now you have more smaller slices. A stock split works the same way. When a company or an ETF, like SCHD, decides to split its shares, they're simply increasing the number of shares while reducing the price per share. So let's say SCHD was trading at $90 per share before the split. After a 3-to-1 stock split, that price would drop to around $30. But you'd now own 3 shares instead of 1. Your total investment value stays the same, but each share is now more affordable for investors. One of the main reasons companies and ETFs do this is to make their shares more accessible to a broader range of investors, especially those who may not be able to afford the higher price tag. This is particularly important for platforms like Schwab, which don't offer fractional share trading on ETFs, unlike some other platforms. By splitting the shares, SCHD opens the door for more investors to buy in without having to commit to the full $90 per share. Now that we've talked about the stock split, let's dive deeper into what makes SCHD such a standout ETF for investors. First up is the dividend yield. SCHD currently offers a 3.4% dividend yield, making it one of the higher-yielding ETFs in the market. But what's even more impressive is its dividend growth. Over the past 5 years, SCHD has delivered an average dividend growth rate of 12% per year. This means that investors not only enjoy strong payouts today, but can also expect these payouts to increase significantly over time, boosting long-term income potential. To put that into perspective, let's compare SCHD with 2 of its biggest peers, Vanguard High Dividend Yield ETF, VYM, and iShares Core Dividend Growth ETF, DGRO. While VYM also offers a high yield, its dividend growth has been slower, hovering around 7 to 8% annually. On the other hand, DGRO focuses more on growth and less on yield, with a lower dividend yield than SCHD. This balance between yield and growth gives SCHD an edge, especially for investors who want both consistent income and growing dividends. In terms of performance, SCHD has delivered a strong 19% return over the past year, showcasing its resilience even in volatile markets. This is no fluke. Over the last 10 years, SCHD has consistently outperformed many of its peers by carefully selecting companies with a strong dividend history and solid fundamentals. What really sets SCHD apart, though, is its diversification and stock selection strategy. It focuses on companies that not only pay dividends, but also have a history of financial stability and strong earnings growth. By holding a mix of high-quality companies from sectors like consumer goods, technology, and healthcare, SCHD offers a well-balanced portfolio that can thrive in both strong and uncertain market conditions. So, if you're looking for a well-rounded ETF that delivers on both income and growth, SCHD's unique blend of high dividend yield, fast dividend growth, and capital appreciation makes it a compelling choice. Let's get to the big question. Why did Schwab decide to split SCHD's shares? While stock splits might seem like a surprising move for an ETF, Schwab had a very clear purpose behind it, making SCHD more accessible to a wider range of investors. Prior to the split, SCHD was trading around $90 per share, which might not seem expensive, but it can limit smaller investors who might not want to commit that much capital to a single share. One of the main reasons for this move is Schwab's platform limitation. Schwab does not allow fractional share trading for ETFs. This means that if you're investing through Schwab and want to buy SCHD, you have to purchase whole shares. So if you don't have $90 to buy a full share, you're left out. By splitting the shares 3-to-1, Schwab has lowered the price to around $30 per share, making it more affordable and allowing a broader range of investors to add SCHD to their portfolios without a large upfront investment. This is particularly important for retail investors who may be starting out or building positions in smaller increments. Platforms like Fidelity and Robinhood allow fractional trading, but Schwab has not yet followed that trend for ETFs. So instead, they opted for this stock split to make SCHD more accessible, especially for those who use Schwab's platform. The split also benefits investors by making SCHD more liquid. A lower price per share means that buying and selling SCHD becomes easier for investors at all levels, which can potentially increase trading volume and provide better price stability. In summary, Schwab split SCHD to increase accessibility, especially for their own platform users, and to enhance liquidity, without changing the value of the ETF. It's a smart move that opens up opportunities for smaller investors and ensures that SCHD remains one of the most accessible dividend-focused ETFs on the market. Let's take a closer look at SCHD's top 10 holdings, which make up 41.01% of its total assets and offer a diverse range of strong dividend-paying companies. First, we have BlackRock, Incorporated, BLK, the world's largest asset manager, holding a 4.20% allocation in SCHD. BlackRock's PE ratio of about 20.1x is slightly higher than the financial sector average, but this is due to its dominant position in asset management and the continuous growth of its iShares ETF products. Its 2.16% dividend yield complements its consistent revenue generation, making it a stable choice for long-term dividend growth. Next, the Coca-Cola Company, KO, representing 4.16% of SCHD's holdings, is a consumer staples giant with a PE ratio of approximately 23x, above the sector average, but justified by its global market dominance. Coca-Cola's 2.70% dividend yield is supported by its strong cash flows and a diversified portfolio of beverages, making it a reliable dividend payer. Similarly, the Home Depot, SCHD, at 4.10%, provides a robust 2.25% dividend yield and has a PE ratio without NRI around 26.84, in line with the sector average. Its strong presence in home improvement retail and steady demand from both homeowners and contractors ensure continued growth prospects, even in uncertain economic environments. Cisco Systems, Incorporated, CSCO, with 4.03% of SCHD's assets, trades at a relatively low PE ratio of 14.7 times compared to the technology sector's average. Cisco's 3% dividend yield, combined with its leadership in networking technology and expansion into software and cloud services, makes it a key holding with strong future growth potential. Texas Instruments, TXN, holding a 4.02% stake, operates in the semiconductor sector and trades at a price-to-earnings ratio of around 32.1 times, slightly above average. However, its focus on analog chips, which are essential across industries, positions it for stable growth. Texas Instruments' 2.60% dividend yield reflects its steady performance in a critical sector for modern technology. In healthcare, Amgen Incorporated, AMGN, and Bristol Myers Squibb Company, BMY, account for 3.99% and 3.95% of SCHD's portfolio, respectively. Amgen's PE ratio of 15.4x is in line with the sector, and its 2.79% dividend yield is supported by strong earnings and an innovative pipeline in immunology and oncology. Bristol Myers, on the other hand, trades at a low PE ratio of 7.2x, well below the healthcare sector average, signaling that it may be undervalued. Its 4.71% dividend yield is underpinned by a solid portfolio of high-margin patent-protected drugs, ensuring future income stability. Lastly, Verizon Communications Incorporated, VZ, which holds a 3.71% allocation, offers an attractive 6.04% dividend yield, but faces challenges from competition and a saturated U.S. market. However, Verizon's investments in 5G infrastructure could drive long-term growth. With a P/E ratio of 9.5x, it trades well below the sector average, making it an interesting value pick in the telecom space. Overall, SCHD's top holdings represent a mix of undervalued opportunities and steady dividend growth. Companies like Cisco and Verizon are trading below their sector averages, offering potential for future capital appreciation, while Coca-Cola and Texas Instruments might trade at slight premiums but continue to deliver reliable dividends. Looking ahead, the growth drivers for these companies, such as 5G expansion for Verizon, increased demand for networking technology at Cisco, and breakthrough therapies from Amgen and Bristol-Myers Squibb, suggest that SCHD is well-positioned for both income and growth. When assessing SCHD, it's essential to recognize the risks that could impact its performance, especially in today's volatile market. Rising inflation can erode the purchasing power of dividends, which is a core component of SCHD's appeal. As inflation rises, the real return on dividends decreases, making them less attractive. Additionally, the ETF is vulnerable to rising interest rates. When rates climb, dividend-paying stocks like those in SCHD can face increased competition from bonds, which may offer more attractive yields. Sectors heavily weighted in SCHD, such as technology and healthcare, may experience market volatility due to economic uncertainty or sector-specific challenges. While SCHD's broad diversification helps mitigate some of this volatility, it's essential to note that individual sectors like telecommunications, where Verizon operates, may struggle with market saturation, limiting growth potential. On the brighter side, SCHD's forward-looking growth remains promising, especially as it continues to adjust its portfolio through strategic rebalancing. Historically, SCHD has outperformed during periods of market volatility and economic downturns by relying on high-quality dividend-paying companies. Its focus on companies like Cisco and Amgen, which are leaders in their respective industries, positions the ETF to capitalize on long-term growth drivers such as the expansion of 5G technology and advancements in biotechnology. Moreover, SCHD's regular rebalancing ensures that the ETF stays aligned with evolving market conditions, potentially adding new high-growth dividend stocks that enhance overall portfolio performance. Investors should also keep an eye on macroeconomic trends. If inflation cools and interest rates stabilize, SCHD could see renewed interest from those seeking both dividend income and capital appreciation. In conclusion, SCHD's recent stock split is creating buzz, and for good reason. With its focus on solid, dividend-growing companies like BlackRock, Coca-Cola, and Texas Instruments, this ETF continues to offer an appealing mix of stability and growth potential for long-term investors. Despite potential risks from inflation and rising interest rates, SCHD's historical resilience and strong dividend growth strategy make it a compelling choice for those looking to build wealth over time. If you're considering adding SCHD to your portfolio, the current market conditions might provide an opportunity to lock in strong yields while positioning yourself for future growth. Is SCHD part of your portfolio? What do you think of its recent stock split? Let me know in the comments below. And don't forget to subscribe for more insightful content on dividend ETFs and investing strategies.